All right, everyone. So, in this section, I'm going to be talking about the fundamentals of trading. So, to get started, you want to first learn what is the stock market and what is the Forex market. Well, the stock market is a market that's comprised of companies that are raising capital by issuing shares to investors. And these investors buy and sell stocks through exchanges like, for example, New York Stock Exchange or NASDAQ, which is one of the biggest exchanges. And the stock market also offers investment options like stocks, bonds, ETFs, and mutual funds that investors can invest in. Stock market also has stock prices that fluctuate, and how these prices fluctuate is all based on supply, demand, and many other external fundamental factors. But it's mainly moved by supply and demand, which is something very crucial that we will understand and develop later into this course. Now, diving deep into the Forex market, the Forex market is very similar to the stock market, as in it is also moved through supply and demand and fundamental factors. However, the Forex market is a global marketplace for trading currencies, facilitating international trade and investments. So it's a much bigger market with obviously just a lot more money than the stock market in general. So the Forex market is the largest and most liquid financial market with trillions of dollars traded daily. That is much more money than the stock market. The stock market is made up of roughly, I believe, 50-ish billion dollars. Correct me if I'm wrong, but definitely in the billions. The Forex market is in the trillions. The difference between a billion and a trillion is 1,000 times. So you guys do want to keep that in mind when you're trading and deciding which market you want to pick from, right? These are two whole different industries. And in the Forex market, traders speculate on currency movements to profit from fluctuations, right? We have currency trading pairs. For example, we can have Euro USD, Euro dollar with USD, or we can pair USD with Japanese yen. So that's something I'll dive deeper into as we go into and explore the Forex market. But that's basically the gist of how the Forex market is traded in terms of assets compared to the stock market, which is more like companies. Now, how does the market moves and who moves the market? This is something logically that we must understand as traders. If you don't understand this, it doesn't make sense to be going into trades and putting your position on the line and risking money, of course. So from a technical standpoint, the market moves from buyers and sellers. For every buyer in the market, there must be a seller on the other side that's selling you the share or option contract for you to buy. So every single buyer, there must be a seller. Every single seller, there must be a buyer. This is something that you definitely should know as a fundamental basis of trading and how it works. So the market cannot necessarily be rigged towards one side by a lot because every buyer, there has to be a seller. There are some exceptions to this though, which I'll dive later into, which are called imbalances in certain areas. But basically, supply and demand drives market dynamic movements. Now, from a fundamental aspect, the market can also move due to economic indicators and news impact that impacts market sentiment. And this impact usually deals a lot of change to more so long-term investors that might want to get out of their position if there's a really bad news going on, or even day traders that hear bad news and they sell out of their position because they're scared. So fundamentals do also play a role in how the market moves, but as day traders, we want to take into consideration both, and I'll teach you guys how to do that later on. So retail traders like us have very minimal effect on the market. We don't move market price. We essentially have no change to the market. The market does not care about our positions because one of us makes no difference. Now, of course, if you include like 80% retail traders, that's gonna, move the market by a good amount. But by ourselves, with the money we personally have, is not enough to move the market. I have seen on order flow a order size, for example, like 15 million, and it did not move the market by that much. You would expect 15 million to be a large sum of money that would move the market by a lot. This is a day trade buyer. This is a single position someone put in for 15 million, and it did not move the market as much as you would expect. So that just keeps you on a perspective of how much money there truly is to be made from these markets. Now, banks and institutions are the main participants causing a shift in market momentum. So what does this tell us? Well, 90% of retail traders, first of all, lose money, meaning only 10% make money in the long run consistently. Now, this isn't to discourage you from day trading, because you could definitely day trade for a living for sure. Obviously, it's better to still have stable income on the side, puts less psychological pressure and emotional pressure on you. But there are definitely many people day trading as a living as only source of income out there. Just to let you guys know, that's the thing. 10% might seem really low, but if you compare these stats to many other industries like the acting industry, professional sports, literally any high paying return on investment industry, there's less than even 2% make it. I'm pretty sure NBA, there's only 0.001% of D1 players make the league, right? And we can talk even more about acting and all these other industries are even the crazy low percentages of getting in, especially you can even look at college admission. 10%, it's harder to get it into MIT or Harvard or any Ivy school than it is to become a successful long-term, consistently profitable retail trader and make money in the markets just on your phone, maybe an hour or two a day. Literally, straight up. Those are the statistics. Only 10% make money, but that's a good percent. Now, part of the 90% that lose money, what they don't consider in these statistics is part of these 9% are people that just quit. Obviously, if you quit, you're considered losing money. So this isn't the most accurate statistic we can go off of. Anyway, nonetheless, what this tells us is that to become part of the 10%, we need to think and trade on the side of the institutions and not retail. We should not be thinking about how retail should be trading. Instead, we should be trading against retail. Now, I'll dive deeper into how we can analyze this on a technical aspect of the chart, but that is something you want to keep in mind logically. We want to think in a reverse psychological way, which is something you got to program your mind to, right? Because when you see price going up and see these green bars, many people are going to think of buying. But what these institutions are thinking of, first of all, they're already in their buying position, so it's already too late. Second of all, they're thinking of selling. At what price point is it good enough for me to sell my position? This will drop the market. So we got to think opposites when it comes to getting good entries and trading on the side of institutions and not retail. So if 9% are losing money, what should we be doing? We should be doing exactly the opposite of what 90% of people are doing. So we just got to be different. Now I'm going to talk about what is market news and how it affects us as traders. All right, so here is a website called forexfactory.com. I would highly recommend you guys bookmark this website. It is very important. It includes news for the whole market, whether that's Forex or stocks. It includes all of the news that will come out on that day, on the week, on the month. It has tons of categories you guys can look into. But the main point of this website is to check for major news that will affect our trading positions and our just trading performance in general, right? So these yellow folders, as you can see under impact, these are very minimal effects. This basically shows this news release will not really affect the market by much. So don't be fooled or scared. So usually it is completely fine to trade or be in a position while the yellow folders are ongoing. That's completely fine. Very minimal effect. These orange folders are something you would want to pay more close attention to, and because these have moderate effects on the market, which may move the market by a good amount, but not anything crazy significant, right? So orange folders and red folders are two main folders you want to be focusing on. And on Forex Factory, you can actually filter out all the folders, so it only shows orange and red folders, which is what I would highly recommend you doing, because yellow is just, the thing about yellow folders is all news, all noise, doesn't matter. Now, the reason why I made red folders in red font here is because we really want to avoid trading during major news. You could gamble, like if you have a trade on or you take a trade during red folders, during major news, like unemployment rate, that's massive, non-farm employment change, NFP, that's also massive. You are basically gambling. I won't lie. You're gambling as a trader. You're not sticking to your trading system, your setup. You're literally just gambling on how the news is going to go. So I would highly recommend just avoid trading during major news. And the reason why is because what they like to do during news sometimes is do a fake out to both sides. What this does is it literally fakes you out on both sides, so stops out traders that have stop losses, and it will psychologically fake you out thinking you're wrong, and then it goes in the right direction, and it does the complete opposite to the other people on the other side. So just in general, avoid trading during major news. That's obviously just a key fundamental thing that you just have to know. So you must know what time news comes out and what currencies, for example, affects, right? USD is going to affect all of the stock market, obviously. And for the other currencies, you want to focus mostly on those currencies. So if it's a CAD currency that's, orange folder, red folder, you want to be careful when you're trading CAD pairs. But there's different types of news. The first type of news is earnings reports, which are quarterly results of companies that impact stock prices. This only affects the stock market. For example, companies that have an earnings report quarterly saying whether the company is doing good or bad. Usually these reports come out during aftermarket, so not during like the trading session, but it's something to keep in mind of. We also have economic data releases like GDP, employment, and inflation that affects the market sentiment. These are pretty big folders that are typically be found as orange or red. We also have company-specific news, product launches, legal actions. Again, for example, Twitter, Facebook, something going on with them, with lawsuits, things like that. Company-specific news that will, again, this is more so towards the stock market people, where you should just keep this in mind when trading a certain stock. We also have geopolitical events like elections. That's massive. Trade disputes, tensions affecting global markets, and just global disputes in general. You want to be careful of this. You want to make sure that these are not affecting our trades in the market, because you never know. There's sometimes literally the market would drop or pump so much it's absurd. So there's that. And last but not least, Federal Reserve announcements, FOMC, which stands for the Federal Open Market Committee. This is mainly for, I would say, the stock market. This does sometimes do affect the Forex market, because if you're trading a USD pair, that's also a Forex market. Or if you're trading something like an asset like oil or gold, which you could be technically consider that Forex. So that's something you want to keep into consideration, right? FOMC is a very big meeting, and this is where central bank decisions impact interest rates, and of course that impacts the market. Next, we want to learn about our must-know trading terminology. Now, these are lists of terminology terms that we must know as traders.